Okay, so 4 times a year, the entire stock market basically holds its breath. It's time for what I like to call every public company's Super Bowl, earnings season. And man, it is a time of high drama, big moves. And let's be honest, sometimes it's just completely confusing.
I mean, you've seen this headline before, right? Some company announces absolutely fantastic results. They beat earnings, and then you just watch as its stock price completely tanks. It's one of those moments that makes you just scratch your head and think, wait, what is going on here?
So yeah, how does this happen? That is the million-dollar question. And in this explainer, we're going to break down the entire playbook. The goal here is for you to not only understand the game, but to actually learn how to play it like a pro. To get to the bottom of this paradox, we first have to understand the basic rules of the earnings season game. And you know what? It really all boils down to one simple word: expectations.
First off, what even is earnings season? Well, it's those 4 special times a year, usually January, April, July, and October, when public companies have to open up their books and give everyone a report card on how they've been doing. And these reports, they can move the whole market.
Now here is the one term you absolutely have to know, because it dictates everything. It's the consensus estimate. This is the magic number. It's the average guess from all the big Wall Street analysts, and it becomes the official benchmark, the number everyone is laser focused on. And the stakes? They're pretty high. If a company's results come in higher than that consensus number, they beat expectations, and usually the stock gets a nice reward. But if they fall short, they miss, and the stock can get absolutely hammered. And get this, even if the company was still really profitable. It's all about what was expected versus what actually happened. Let's look at a classic example of just totally winning this game. Back in the 90s, Cisco Systems was an absolute master at this. Get this, they beat Wall Street's expectations for an unbelievable 43 quarters in a row. And the result? Well, investors loved that consistency, and the stock price just exploded upwards. But what happens on the flip side? What happens when a company keeps disappointing investors? Well, the fallout can be absolutely brutal. Just look at this number, a drop of over $79 per share. That staggering drop belonged to a company called Lucent Technologies. Between 2000 and 2001, they kept missing their numbers, and investors just fled. The stock completely collapsed, going from $80 all the way down to 75 cents. It just goes to show how punishing this game can be.
Okay, so the rules seem simple enough, right? Beat the estimate, your stock goes up. Miss it, stock goes down. But here comes the plot twist, because this game isn't nearly as straightforward as it looks on the surface.
And this brings us to a really crucial point. Just how good are these magic numbers in the first place? You see, the truth is, trying to predict a company's future earnings is incredibly difficult. And that means those all-important analyst estimates, well, sometimes they're little more than educated guesses.
Which naturally leads to a really interesting question. If these numbers are so hard to pin down, how is it that so many companies seem to beat them quarter after quarter after quarter? Are they all just financial geniuses, or is there maybe something else going on behind the scenes?
Well, welcome to the world of earnings management. See, to hit that magic number, companies have a few tricks up their sleeve. They might, say, record some revenue a little early, or maybe they push some costs into the next quarter. Another classic is offering huge discounts right at the end of the quarter just to juice the sales numbers. Now, these moves can manufacture a beat for sure, but they don't always tell you about the true health of the business.
So knowing all this, how do you avoid getting played by the headlines? Well, that's what we're here for. Let's build your savvy investor playbook so you can start thinking just like a pro.
First things first, you have to look beyond that one single consensus number. The 4 cents per share you see in the news, that's just an average. The reality is that there's often a huge range of opinions hiding behind it. One analyst might be predicting 2 cents, while another is way up at 6. That simple average completely hides the real story.
So here it is, your pro checklist. First, always look for the full range of estimates, not just that simple average. Then, try to figure out which analysts actually have a good track record. And this one is so important. If a company does miss, ask why. Was the business itself weak, or were the analysts just way too optimistic? Because sometimes a big price drop on a miss could be a fantastic buying opportunity if you know the underlying company is still solid.
And really, this is the key takeaway. That big, dramatic, crazy stock price swing you see on earnings day, a lot of the time, that's just a short-term emotional reaction. It's the noise. It is not always a true reflection of the company's real long-term value. That's the signal. Your job, as a savvy investor, is to learn how to separate the noise from the signal. So the next time earnings season rolls around and you see those screaming headlines about who beat and who missed, what are you going to do? Are you going to have that knee-jerk reaction with the rest of the crowd? Or are you going to pull out your new playbook, dig a little deeper, and actually analyze what's going on? It's your call.